a $313 billion company, a 207 times earnings multiple, and the most famous short seller in history just bet against it. Michael Burry, the man who predicted the 2008 financial crisis, has taken a position against Palantir. And Wall Street is split right down the middle on who's right. But there's one number buried in Palantir's financials that almost nobody is talking about. And by the end of this video, I'll show you exactly why it changes everything. I'm Adrian. Let's break it down. Let's start with what Palantir actually is. Most people hear AI company and think chatbot. Palantir is nothing like that. They build software that helps governments and corporations make decisions using their own data. Think military intelligence, supply chain optimization, fraud detection, counterterrorism. Their flagship products, Gotham, Foundry, and now the artificial intelligence platform, are used by the CIA, the U.S. Army, and dozens of Fortune 500 companies. And the numbers are staggering. In 2025, Palantir's revenue hit $4.48 billion. That's up 56% from the year before. In Q4 alone, revenue grew 70% year over year. But here's what really stands out. This is a company that went from losing $520 million in 2021 to earning $1.63 billion in profit in 2025. Operating margin went from negative 27% to positive 32% in 4 years. Free cash flow hit $2.1 billion. That's a 47% free cash flow margin. For context, Microsoft's free cash flow margin is about 33%. Palantir's is better. They delivered their 10th consecutive quarter beating both revenue and earnings estimates. Not one miss, not two, to 10 in a row. So you might be thinking, what's not to like? Here's where it gets uncomfortable. Palantir trades at a PE ratio of 207, forward PE of about 72, price to sales ratio of nearly 70. To put that in perspective, Microsoft trades at a forward PE of about 30. Alphabet trades at about 20. Even CrowdStrike, and one of the most expensive cybersecurity stocks, trades at about 80. Palantir is priced like it's already won the AI war. And that's before you factor in the share dilution. Shares outstanding grew from 1.9 billion in 2021 to 2.38 billion in 2025. That's a 25% dilution in 4 years, mostly from stock-based compensation. So while revenue grew 56%, the share count also grew, meaning earnings per share didn't grow as fast as profits. This is the tension at the heart of the Palantir story. The business is genuinely excellent. The valuation assumes perfection for years. Which brings us to Michael Burry. Burry runs Scion Asset Management, a small, concentrated fund famous for one trade. In 2005, he bet against the U.S. housing market. Everyone thought he was crazy. 2 years later, the financial system collapsed and he made a fortune. Since then, every move Burry makes gets headlines. He shorted Tesla. He shorted the semiconductor sector. He bet against the S&P 500, and now he's positioned against Palantir. Now here's what most people get wrong about Burry. He's not always right. In fact, he's often early, which in markets can feel the same as being wrong. He shorted Tesla at around $250. It went to over $400 before eventually pulling back. He was right on the thesis, but the timing cost him. His bet against Palantir isn't necessarily that the company is bad. It's that the stock is overpriced relative to what it can deliver. At 207 times earnings, even a 30% revenue miss would be catastrophic for the share price, and there's a precedent for this. In the dot-com bubble, Cisco traded at 200 times earnings. The company itself was fine. Cisco is still a massive, profitable business today, but the stock dropped 80% and didn't recover for over 20 years. Burry isn't betting against Palantir, the business. He's betting against Palantir, the valuation. Now here's the part that almost nobody is covering. The real question isn't whether Palantir is overvalued. It probably is. The question is, does it matter? And here's where I want to share the one number that changes this debate. Palantir's net dollar retention rate. This measures how much existing customers spend over time. A number above 100% means customers are spending more each year without Palantir needing to sell them anything new. Palantir's net dollar retention has been above 115% for multiple quarters. Think about what that means. Even if Palantir never signed another new customer, ever, their revenue would still grow 15% a year just from existing clients expanding their usage. This is the moat, not AI hype. Not government contracts, not buzzwords. It's the fact that once organizations start using Palantir, they can't stop, and they keep spending more. That's the difference between Palantir and the dot-com companies Burry is comparing it to. Cisco sold hardware. Customers could switch vendors. Palantir sells a data operating system. Once it's embedded, ripping it out is nearly impossible. The switching cost is the moat. So here's my honest take. I think both sides have valid points. Burry is right that the valuation is stretched. At 207 times earnings, Palantir needs to execute flawlessly for years to justify the price. And history shows that's extremely rare. But the bulls are right that this isn't a normal company. 56% revenue growth, 32% operating margins, 47% free cash flow margins, net dollar retention above 115%. These are elite metrics, better than almost any software company on earth. So what would I do? If you own Palantir and it's a small position, hold it. The business deserves exposure, even if the valuation is scary. If you're thinking about buying, wait for a pullback. At $100 to $30, you're paying 207 times earnings. At $80 to $90, where it was just 6 months ago, the risk-reward looks completely different. If you're thinking about shorting it like Burry, be very careful. Expensive stocks can stay expensive for years, and betting against a company growing revenue 56% a year is a dangerous game. I'm genuinely curious. Do you think Burry is right or wrong on this one? Drop your take in the comments. The lesson from Burry versus Palantir isn't about who's right. It's about understanding that great businesses and great investments are not always the same thing. The stock price reflects the future. And when everyone agrees the future is bright, the price has already moved. If this helped you think about Palantir differently, subscribe. I break down one stock or macro topic every week. I'll see you next time.